Welcome to This Explainer. Today, we are going to completely change the way you look at a price chart. Seriously, we're going to decode the hidden footprints of massive institutional players. And the goal here is to turn you from a reactive retail trader into an anticipating market detective. If you've ever felt like the market is just, moving right past your setups, or if you constantly find yourself entering a trade exactly when the momentum reverses, well, you are in the right place. We're going to map out exactly how the big players operate, and we're going to do it by learning to read the blank spaces they leave behind. Okay, let's dive into this by asking a really tough question about your current trading strategy. Are you totally blind to the massive institutional orders driving the market right past your setups? So many traders focus entirely on indicators, trend lines, or these crazy complex algorithms, and they completely ignore the most obvious structural clues sitting right in front of them. The raw, unfiltered price action contains hidden pockets of error, imbalances that dictate exactly where the market is going to draw to next. Honestly, if you're ignoring these imbalances, you're basically trading with one eye closed. So today's explainer is essentially your visual masterclass. We'll be methodically walking through 5 specific types of price imbalances, starting with the core philosophy of smart money footprints, diving deep into fair value gaps, exploring balanced price ranges, analyzing both volume and gap imbalances, and finally uncovering the dangerous breakaway gap. Let's kick things off with Section 1, the smart money footprints. This is the absolute foundation of smart money concepts. You see, we're no longer looking at a gap as some random glitch in the data feed or just a weird jump in price. I really want you to internalize this. A gap is a deliberate, powerful footprint. Think about it. When an institution needs to move billions of dollars, they literally cannot do it quietly. They inject massive liquidity into the market so aggressively that they just skip entire price levels. That empty space on your chart? Yeah, that's not nothing. That is the physical, undeniable evidence of heavy, aggressive institutional orders. Leveling up your trading execution requires a massive psychological shift. You aren't just learning a new candlestick pattern today, you're learning to read the mind of the market maker. By understanding exactly why these specific zones are targeted by algorithms, you stop guessing, you start tracking. You begin to see the chart not as random ticks, but as a carefully orchestrated delivery of price. Which brings us to Section 2, mastering fair value gaps. This is really the anchor piece of evidence in any smart money trader's toolkit. So the absolutely crucial point to understand here is that a fair value gap, or FVG, is essentially a giant magnet. When the market moves so fast that only buyers or only sellers get to trade, it creates a total imbalance. And the thing is, the market is naturally efficient. It absolutely hates a vacuum. Because that initial move was so aggressive and one-sided, the algorithm will very often pull the price right back to this exact sketched out zone to pick up remaining orders and offer a fair trade to the other side. Let's actually sketch this diagram out mentally, or literally write the text out on your own charts as we speak. Imagine a sequence of 3 candles. Step 1, you spot a massive, aggressive candle. Boom, that's your displacement. Step 2, you look at the candle right before it and mark the very tip of its wick. Step 3, you look at the candle right after the massive one and mark the tip of its wick. And step 4, look closely at the space between those 2 wicks. Is there a blank, empty space where they don't overlap? If yes, draw a detailed sketch of a box right there. You've just successfully mapped a fair value gap. By sketching these gaps out and explicitly writing this text on your charts, you're no longer guessing. You are tracking the exact entry coordinates of the market's biggest whales. You're drawing a box around the exact, precise price level where an institution stepped heavily on the gas pedal. And this right here perfectly illustrates the psychological divide. While a retail trader reacts to that massive candle with pure FOMO, sweating, panic buying, and chasing the price at the absolute top of the move, the smart money trader is perfectly calm. They sketch out the FEG and they wait. They patiently anticipate the return to that gap so they can enter alongside the institutions, getting a premium entry price, while our poor retail friend is getting stopped out. All right, let's see how this builds in Section 3, balanced price ranges. Once you've mastered drawing a single FVG, we have to look at what happens when these gaps violently overlap. Think of a balanced price range, or BPR, as a heavily contested battlefield. Imagine the market rapidly pushing up, leaving a bullish FVG. But then, almost instantly, massive selling pressure slams the price right back down through that exact same zone, leaving a bearish FVG directly on top of it. The market has rapidly pushed through a single zone twice, effectively balancing it out. Because the institutions have already settled their business in both directions within this exact zone, a BPR acts as a powerful structural barrier. It is literally an absolute brick wall. When price eventually wanders back to a balanced price range, it will typically hit it and immediately reject it. As a market detective, you can use these BPR walls to confidently frame your risk and tuck your stop losses safely behind them. Moving right along to Section 4, Volume and Gap Imbalances, we're going even deeper into the microscopic details of the charts here. Now, a volume imbalance, or VI, is a super subtle clue. Imagine sketching out two candles right next to each other. Their long wicks might touch or overlap, so a typical retail trader thinks everything is completely normal. But look closely at the thick bodies of the candles. If the body of the first candle and the body of the second candle do not overlap at all, you have a volume imbalance. The price was technically delivered there via the wicks, but the heavy, committed institutional volume was completely absent between those candle bodies. In stark contrast, a gap imbalance is totally impossible to miss. This is your traditional gap where absolutely nothing touches. Neither the bodies nor the wicks of the two consecutive candles overlap. It's a glaring, totally empty void right there on your chart. It's essentially a missing chunk of price action. The underlying implication of these specific imbalances screams extreme institutional urgency. When you spot a volume or gap imbalance, you are looking at raw, unfiltered momentum. Smart money was in such a crazy rush to reprice the asset that they couldn't even facilitate a two-way trade. The algorithm literally just jumped prices to get to the destination faster. Finally, we arrive at Section 5, the breakaway gap. This is the fifth and absolutely most dangerous footprint we'll cover. This is where the psychology gets really advanced, and it's exactly why you need to be a true market detective. Remember how we said FVGs act like magnets and usually get filled? Well, a breakaway gap is the devastating exception to that rule. Institutions will deliberately create a massive FVG and then intentionally leave it open. Why? To strand retail traders who are desperately sitting on the sidelines waiting for a pullback that is never, ever going to come. So, context is everything here. If you sketch out an FVG and the market consolidates above it but stubbornly refuses to dip back down into your box, you're looking at a breakaway gap. The trend is just too strong to look back. Recognizing this allows you to stop fighting a runaway train, cancel those limit orders you placed way too low, and instead find a way to just ride that massive wave of institutional momentum. Let's quickly summarize your new smart money arsenal. You now have 5 precise structural clues to chart out: the FVG for spotting premium pullbacks, the BPR for finding absolute brick walls in price, the volume and gap imbalances to detect extreme algorithmic urgency, and the breakaway gap to keep you out of consolidation traps during those massive trends. Together, these 5 gaps decode the algorithmic delivery of price. Now that you know exactly what these structural clues look like and the deep institutional psychology behind them, I want to leave you with this final thought. How are you going to adjust your strategy tomorrow morning? Are you going to continue to chase retail indicator signals? Or will you wait patiently, sketching out those invisible footprints and enter precisely where the market makers do? The clues are right there on the chart, just waiting for you to find them.